Yeah. Hey everyone, great to be on with you via Financial Juice. If you don't know me, I'm Will Sebastian. I'm a pro multi-asset day trader. I teach people around the world and trade for income myself. Now, this particular webinar, I've seen quite a few already that other guys have done. Mine is going to be a bit more charts focused. So we're going to go over the reality of how these things actually work. It's not just going to be a boring sort of slideshow. But there are going to be a couple of slides just to get the written information there, so then we can go through and assess that with an example on a chart, because it's all well and good me sort of telling you why I do something or something like that, but it's no good really if I don't physically show you literally what I'm talking about. So what makes trading work? That's what I've made this sort of webinar called, if you like. And the reason why is because that really is going to nail it. That's what everyone's here for. I think everyone who's here might be trading themselves, or you might have seen me somewhere or come from Financial Juice, whatever it may be. But we're going to look at the core parts that need to come together as a necessity, really, to make the whole system work. There's lots of different trading mentors out there, people who talk about trading. Some of them do trade, some of them actually don't. But nonetheless, a lot of what they say is very focused on one part. But for myself, it's various parts that come together to make the whole picture work. So, like I said, I'm Will Sebastian, pro multi-asset day trader. I am the co-founder and co-mentor at the Trading Mentor. That's what our live training room is called. We teach people live on charts every day. I was doing it earlier for the New York session. Spent a couple of hours doing a top-down analysis, so going through a wide portfolio and everything that everyone needs to know. I'm also the top liked and shared streamer and author for TradingView. I'm routinely on the front page and work with them fairly closely, just publishing my analysis. So what will you be shown today? Like I said, I'm going to move this out the way a little bit. I think everyone can still see me okay. Some of you might not want to. I'm sure you'll be more focused on what's going on. But like I said, there's going to be no boredom. It's not just going to be a series of boring slides about how great I am and how much I know. It's going to be an application on charts with real examples today. So probably some of the markets lots of you are looking at right now. I'm going to give my take on them, where I'm at with them in my own personal portfolio, why, how, and what I really consider within my trading plans. And that goes for day trading, swing trading, and occasional scalp trading. Mainly for myself, I'm a swing trader. It suits my lifestyle. I run various businesses. I teach various academies. And it means I can do things at my leisure. There's still work to be done there. I can still, come in and manage positions. I'm not just being completely lax and letting go. I do spend a lot of time in the office just managing my portfolio and, like I said, teaching others. But this is going to be mainly focused on how I trade consistently for income, my strategy. We're going to apply that to charts in 5 different ways on 5 different assets that we'll pick. Why people actually lose money trading, which you'll really enjoy, I'm sure, because it has a little bit of a different angle I take in quite a unique way, because the way we trade is not like normal. I would say probably you're not going to bump into people who trade in the same way as us. It's a very unique and different way, but it does work very well. And how, of course, you can stop losing money and or be accurate and find real consistency, because consistency leans on having a plan, essentially, and adjusting that plan as you see fit based on market sentiment, of course, which is very, very relevant now, because lots of you, like I said, might be users of Financial Juice and come across there. Very, very handy and neat news to have, which we'll discuss market sentiment as we go and that aspect. And again, of course, apply it to markets right now. So make sure you're here the whole way through, because I promise you, I don't mess around when I do these webinars. I don't really like sitting doing something boring or some half sales webinar going, oh my, just join and just forget about it and do this all later. We're going to do some actual stuff, some actual learning, if you like. So the question box and the Q&A box and the chat is there. I do have it, but I will probably refer mostly to those questions as we get to the end of the webinar. So please do post them as I'm describing what I'm saying. And yeah, some of you will be familiar with me, and you've probably seen me publicly on TradingView. This will be a bit different. I'm going to go slightly further than I normally do. So let's quickly meet each other. Just a bit about me. I've got several dogs. I like walking in the countryside. I watch films. I play the piano. I like teaching people and trading myself. And like I said, I'm a full-time multi-asset day trader. And I own an academy. Trading for me came quite young. I started learning to trade when I was a boy. I was about 14 years old. Firstly, just sort of messed around really, as many people do, and dabbled in you know, the illusions of grandeur, if you like. But I decided that when I started to become more of an adult and a bit more mature, and I got older, I thought I would really go for it. So I basically quit all prospects of going to university, having a job, anything like that. And I started just learning to trade, basically. Took me a while, took me a good amount of time, and many long days, long hours and hours and hours of staring at screens. But ultimately, and fortunately, you know, I'm blessed to be where I am at the place where I trade for income every single day. And I'm fortunate enough to be able to share that with other people as well, which is great from a very real and factual perspective. So a little brief part about me. If you haven't guessed already, I am English. You know, I'm from the UK, if you can't tell from my accent. So the challenges I had to defeat, we will get on the chart in literally one more slide. But just so everyone knows, you know, when I started when I was young, it was hard to find a mentor. That is probably one of the most difficult parts, really, because there are people out there like myself who actually trade and do teach people, but they're much more rare. Some people are very private, you know, they don't want to teach people, they don't want to share it. But the mass market is just people who are absolutely full of crap, unfortunately, and that's really where it all falls down. But for me, I managed to find some really great guys, really much older people who had the experience, hedge fund types. I had to pay for it, don't get me wrong. You know, I had to pay a bit to get there, and I spent a lot of time. But ultimately, I realized it became about making it fit me. I mean, everyone's brain is unique, every person is unique. And I think everyone's understanding of the markets mostly varies. When you do find something that works, what you do is typically you start to change it to fit you. So for me, for example, I was much more suited to swing trading. It gives me time to think, to breathe. It fits my equity size. It fits the way I live my life. It fits what makes me happy. So all these different things came into it. It wasn't just that I learned and that was it, and I just copied exactly what someone else did. I did copy what they did, but I then adjusted it to what made sense to myself. So you might find that that is the case, even on this webinar, when I talk about aspects of my strategy. You might look at that and say, you know what, I'll put that in mine, or I'll think about it in a similar way, but something that is much more relevant to my style, to my equity, my portfolio, all those different aspects which are going to come together, like I said at the start, to make one whole thing. Trading is very much one whole thing. You never really have one aspect that makes you all the money in the world. It's not really like that. You can't have, for example, you know, technical analysis without fundamental. In many cases, you do get plainly technical traders, but if you're never considering what's actually driving the markets, like the sentiment, then you'll suffer. In many cases, your risk won't change. But again, that is correlated with how I do things. So I then had to become competent in that way. I had to make it something where I didn't deviate. I was talking to a member earlier, he was trading gold and his equity size was a little bit smaller, and he was trying to trade gold in a way that worked for him, and he was struggling with the competency part. He was struggling to make that fit him. So I had to sort of, you know, put him straight and say, look, if this is going to be long term for you, you're going to have to make changes that are going to deliver that consistency and allow you to reach competence, because competence is really mode someone gets into after they normally have trained for a significant period of time. Mostly trading is a repetitive process. So usually when I call things out to members, it's something they've seen me do before, okay? But again, it's relevant to me. So I will state how it's relevant to me and they will adopt that and then make it relevant to them. So just remember that and keep that in mind. If you're ever seeing anyone else talk about trading in any way, just make sure that you understand that it's from their perspective. You might reach the same conclusion, both of you, whether something is a long or a short, for example. But the only thing that's going to vary is the way your brain interprets and understands the information, because at the end of the day, everyone does that differently. If not, we'd all be the same. So I did it, like I said. Lots of people don't really believe too much in themselves, unfortunately. But as long as you just literally, it's more or less a law of averages. The more and more you work at that, the more you try, ultimately you get there. Okay, it's like rolling a dice and trying to hit a 3. Okay, you might not hit it on the first 7 throws, but ultimately you'll get there. Imagine it like a very much highly sided, 1,000-sided die or something like that, maybe for ants. But anyone can do it. It's not really discriminative on any basis. It's something everyone can adopt and do. Of course, now I'm going to show you how I do that. So without further ado, let's get into charts, and let's talk about the first part I wanted to discuss within the overall system. I've managed to shorten it to about 5 aspects which are completely relevant for price point picking, maintaining your equity, not over leveraging, and keeping everything in line so that that equilibrium, if you like, is sought after continually. Because at the end of the day, most traders who lose money are looking at massive swings up or massive swings down. That is also known as gambling. And I can tell you it doesn't work. It needs to be a process of lots and lots and lots of smaller trades over a very much extended period of time. Okay, that is simply, again, how I adopted it. The mentors that taught me were great. You know, they said, look, just stop trying to go crazy and make all the money you can. Just massively reduce your size and make loads of trades over time, and you will see an upwards trajectory as long as your risk is right. So let's apply it to charts. Let's start going through that now. Can everyone hear me? Is everyone understood okay? Is there any video problems or sound problems? If that is the case, there's loads of people in here, which is absolutely fantastic. That's great to see. Looks like we're all right. Good stuff. Thanks for letting me know. As I said, as we go through, if you do want to put some questions in there, that's absolutely fine. I will get to those. If they're absolutely screamingly relevant to what I'm saying now, I will stop and answer. I think mostly to just keep things rolling through, I'll do a wider Q&A and we'll base it off the market now and everything like that. So, okay, so the first part with what I'm saying, and some of these points as well, you know, words like price action, you might have heard before, but I think very much widely they're misunderstood. At least in my case of teaching loads and loads of people, you know, people say, oh, it's price action this, but at the end of the day, they're not really understanding it properly. So for me, that comes into 2 other subterms, if you like, which are market value and probability. Now, I'm going to do this specifically on gold because it's quite relevant. I mean, regardless of the chart that you use, the markets are simply a series of probabilities. Okay, every single price point which you buy or you sell at, it has a different chance of occurring. Now, the secret of trading is that nobody actually knows the chance for all those things happening. You don't know what the exact % chance of something falling is or rising at any given time. But to make money in the markets, you don't need to know that. You don't specifically need to know 100% at every single trade exactly what is going to happen. Because remember, like I said, if you're making a large series of smaller trades over a long period of time, you don't need to rely on big swings in win and loss, okay, or massive falls your way, like if you're dying to short your house on the SPX or something like that. You know, you're just going to get roasted if it keeps going away. Now, like I said, every entry and exit, it varies in probability, you know, but there are a few ways which you can more or less increase the chance of the trade you're taking going in the way you really want it to. And a lot of that comes down to, like I said, probability, but what I also call market value. And we're going to apply market value to gold charts now. So it's really important to know that any reliable business, and make sure you understand this fully, trading is entirely business, just like anything else, okay? If you were not on your computer screen and you were selling cars, you're doing the same thing on when you then log on to NT4 or wherever you trade, TradingView, doesn't matter. That dealership is buying the car for less and selling it for more, and so are you. Or conversely, you're selling it for more and buying it for less, right? So you're doing the same thing, and people have done this since the dawn of time, since we were cavemen, okay, chasing each other with clubs and tiger skins, you know, or mammoth skins, or whatever it may be. They were trading things, okay. They were giving something for something else. It's all necessity, and it's the same thing over time. Okay, it's deal making and it's getting value. Whoever gets the most value on their deals over time is the one who's successful, the one who makes money. So I always teach from the stance that you are a deal maker. When you're looking at a chart, you want to buy low and sell high naturally. But you've got to understand the swings in market variance, price action and value and things like that. So what does that look like then? What does it look like if you're taking a trade based on value? So I'm going to show you some examples. Like I said, I mean, we can get any gold ticker. I don't think it matters too much which one we are looking at, and I will refer back to our to the slides, etc. after this, and then we'll look at another point and how it entails, you know, the aspects I'm talking about. So I would say the clearest picture in somewhat recent times is on gold, and the reason why is because on gold you saw this high, okay, so you had improved market sentiment here. Okay, as soon as you get around COVID time, you would have seen it on Financial Juice, I'm sure. The panic comes in, the money goes into gold, and it comes up, okay, as a safe haven asset, essentially. And then what happens? Well, later on, when you get to 22, okay, you reach the exact same point. Now, it is absolutely no coincidence that kind of thing, and here's why. So when I ever use fib levels, okay, people use fib levels for all sorts of reasons. But if you pulled a fib out like this, you can see that the move you've got there is 100% as a retracement. So this short you would have had over here of March 22 was the maximum value on a factual basis for the market at that time. So if we zoom in like this, I think actually if I go like that, there we are, I can move it a bit. This point here held the maximum value and therefore the maximum probability of you making money because the price was the highest it's ever been. And the reason why that's so important is because if you were shorting at that point, of course it fell wildly. And most of the time, professional traders like myself or institutional traders, the larger money in the market, will always be looking at these points in terms of probability and value. Now, lots of people don't get that from that stance. They will see this, they'll see a pull up to here, they will either buy into the highs, which obviously isn't a good idea because you're naturally buying high price, which you would never do in any other business. But you can see, therefore, clearly that the market value is at that point. Now, when you return to that again, well, what happens? Is it a blinding coincidence that you then fall from the same place again? And the answer is no. It's because the larger, more successful money in the market, the winners in the market, are always going to short at a good level of value. And that's exactly what they did. Okay. Now you can see that across the board on those three highs. That overall took you from, like I said, around COVID time when you peaked, and then the sentiment wanes. Okay, people pull their money out of gold, all the way through to May 23. Okay, so in that period, you can easily see that the value is favoring shorts. Now, ultimately, what happens is, however, and this is where lots of traders get stuck and they lose money, is when you return there again over here, you come slightly higher than that high. Now, this is where things change slightly. People like myself saw this high, and you've got to understand that the value is there because it's coming back to, the previous high. It's got the maximum sort of price value of the market. But if you pretend that it can't go any higher and you have absolutely no risk plans, you're going to suffer. Okay, so we call this level decay. Okay? And the reason why we call it level decay, if it lets me type it in kindly, let's get, we call it level decay for a reason. And the reason is because naturally, as you hit the same level in a market, it tends to get weaker. Okay, in other words, you're never going to hit something for forever. Okay, eventually it's going to come through. So all those traders who had already, the ones who made money, they're okay with it going wrong at this point because their risk is significantly lower on the fourth try because they're aware of level decay. Now, overall, the general trajectory for gold anyway is to the upside. It's always come up, okay, since forever. It's gained value. Why would that stop? You could go on for days about why it could, why it couldn't, or whatever. It doesn't matter. But these kind of traders, like I said, will know what size to proportionate to that overall risk in the market. So when you have a level decay and you've hit something so many times, you've really got to ask yourself, how much longer can that go on? But the general basis for what I'm saying is all about price action and probability. When I talk about probability, what I'm referring to is the probability of you making a significant gain. Obviously, that is the highest when you've got the highest amount of value, okay? So at this point in March 22, you had the highest amount of value considering you had only ever gone that high once before, okay? And that's why you fell so hard and then fell so hard again. It's absolutely no coincidence. And as many people say, history repeats itself in the markets. That's absolutely true. Now, let's imagine you're looking for a deal to the long side and you're looking to trade it that way. Do you think it's any coincidence again that you just happen to bounce from the same place there and there just happens to be a bunch of candle wicks all along to the left, okay? And there just happens to be another one there, right? These things are not coincidences. These are areas, what we call flip zones, or areas of price rejection. They're where orders have gone in and out of the market. But, and here's the but, they're also areas of value. This, within this newfound uptrend which you saw, okay, which went like that, okay, where is the value? Where would you say the value is? Well, the value is on dips within the uptrend, isn't it? Because the only time you're going to get maximum value to rebuy something is at the lowest point on its overall upwards trajectory, right? So that's why that happens. People say, oh, it's a good level of support. Well, great. What does that actually mean? What is support? Okay, it's an area of value essentially. So that's why we're always that's where the deal making aspect comes into trading. So you're always looking for the best deal within that overall move. So if you've got that newfound uptrend, like I said, you've got to be planning those longs at areas of considerable value, essentially. If you're planning shorts, they're going to have to be at areas of considerable value. And that is why the markets repeat themselves, because those areas of value are known to those professional traders who trade them in and out at the same place, because they're looking for a good deal repeatedly. Okay, again, that's over the long term. It's not going to work in a day if you decide to take this short once and you've made millions. It's not like that. You'll be taking shorts for years over various assets in very, very small sizes. So you never suffer when things will go your way. Okay, because again, it's averages, it's lots and lots and lots of trades. It's not one or two. It's a myth, basically. So that leads me very much on to my next part, which is risk and sentiment understanding. Now, like I said, Financial Juice actually put something very, very relevant out very recently, and that's why I've decided to look at the yens. And it concerns the Bank of Japan. For those of you who do or do not know, they're looking at ending the negative rate stimulus. which obviously we'll go into live on charts. But essentially, if they start putting rates up, it's going to attract foreign investors or foreign cash, or basically people to save their money in yens because it's yielding a better return. That's generally how currency markets work over time. It's whom has the the best cause for investment. So risk management, therefore, is about associating what your portfolio and equity can handle in terms of the long-term variance of the market, which is why the yen is absolutely perfect for this, because it shows you how far something can swing within that harsh market sentiment. So it's absolutely key to get that. Again, the same person I was referring to that I was teaching earlier, his size that he had implemented into the market was too much for his equity. Now, I said to him, look, if you short that now, yes, it might fall on this exact occasion and you might make a lot more money today. But what about next time? What about the time after that? What about the 5,000 other trades you make over the next 20 years? Eventually, you're going to bust if your size is completely disproportionate to your equity overall. So for ourselves within our academy, we basically split our drawdown overall on our equity per asset and per portfolio, because that allows us to micromanage all sections of the portfolio all in all. Most of our traders who we teach, and in fact ourselves, have split portfolios. So you've got effects in there, you've got indices, metals, things like that. Okay, sometimes other raw commodities, agricultural commodities. But you need to know for every single asset and for the overall portfolio what drawdown you're going to associate with that. And those rules are very specific, because at the end of the day, like I said, you're looking at the long-term swing, which is what we'll see on the yen. So traders who lose money don't look at how far they can survive a move, how far something can go and what it will do to them. And they often over leverage, therefore. So we're very, very hot on that. I've made tons of risk management videos, absolutely loads of them, to stop people busting, because they will say something ridiculous like, and I say ridiculous, maybe you'll get some backlash, I don't know, because it's very common speak, but they'll say, oh, I only risk 2% on every trade. Okay, well, what if you get 10 trades wrong? You've lost 20% on one asset. Okay, you're already 1/5 of the way down. That trajectory of bad trading with a 2% loss is going to blow you out. Okay, you should really be looking at 2% drawdown on an enormous swing if you want to survive. Okay, if that risk is not in proportion to your overall equity, you will always, and I mean this, you will always lose your money at some point. You might make money now, but you will lose all of it eventually. People don't get that, so they over leverage. So you've got to do something to stop that risk going up, and that's essentially where we go with it. So Federico, I'm going to cover that exactly on the charts now. Okay, there we are. So mainly in regards to sentiment. Now I will pick, do we want to go for the dollar yen or the Swiss yen, or just all yens in general? Let's go for the dollar yen. That's probably a good example. So just close that. And by the way, we're going to get on to sentiment more in detail as well, because it's what we're doing. Sentiment is basically the mood of the market, what's driving it, and what drives the market simply is news. At the end of the day, it's why people are getting greedy, why they're fearful, why they're getting in and out of markets overall. So particularly with your dollar yen, and there's a few things that are relevant to yens and what I'm showing. So I will say what I was going to say in regards to the slides, and then I will get on to those questions specifically, because there's some really good ones in there as well. So your dollar yen, you've lost a significant amount of value on your yens over time. You can see that across the board: dollar yen, AUD yen, CAD yen, pound yen, Swiss yen. Particularly the Swiss yen has been humongous because of their rates. Now, you've got to understand that any Forex market is going to be directly tied to interest rates within that relevant economy. Okay? Because central banks that issue the interest rate and decide what it will be are responsible, therefore, for the flow of money in an economy, okay, and the distribution of money, essentially. when, interest rates are higher, people obviously spend less because they have less money. So it slows things up and down. I'm sure many of you are familiar with that. You can read all about it on the internet. And of course we do teach it. But if you look simply over the last 10 to 14 years or so, the yen has lost a considerable amount of value. Now, Japan exports a lot, which is okay, but eventually there is always a point where enough is enough. Okay, the yen can only get so weak. And there's a couple of things you could have done here if to stop yourself getting wasted if you were short. Okay, and that is quite simple to get, because if you were looking and saying, okay, well, look at Japan's rates, look how weak things are going to get, you would have been fully prepared for this market swing. Okay, all the way up to this point when you finally peaked recently at 151. Now, I called this short various times here. That was an editor's pick. Thousands, tens of, maybe even 100,000 people saw it there when I called it short. I called it short again, and I've called it short again now. Now, just quickly as well, what do you notice about the three circles I just labeled in regards to what we were just saying about gold? It is that the larger money market, professional traders, people who get things right consistently, can see that that is an area of value. Okay, why is it an area of value? Well, it's an area of value, number one, because it's high, but number two, because it's been hit once, hit twice, and hit three times. Clearly, someone is selling it. That should be screaming out at you. And yet, lo and behold, people buy and buy and buy and buy and buy, and they completely ignore the sentiment. They don't read into the very shorthand and easy to understand things they may see, like I said, on Financial Juice, which is why it's very ideal. The latest being at 5:04, an hour and a half ago exactly, in regards to the Bank of Japan discussing negative rate exit next week. So you've got factor one, you've got your probability there, that's value, that is short side value. And it's all about managing your risk on the way up, because if you were looking to short this as it rose, there's nothing wrong with that particularly. It just needs to be a case of risk management. Okay? And what I mean specifically is if you short it here, okay, the price does go higher, but you need to ask yourself, how strong is that sentiment? How weak could the yen get? And how harsh is that price action pulling you up? So you would say, okay, well, it is very harsh. Therefore, based on my equity, I'm going to work out the maximum drawdown I could possibly survive on an intense move. I'll prepare for that. I'll space things out a lot. I might take only my second short there. I might only then take a third one much higher. And what you're doing here is you're casting the net out with a much lower size, because you're asserting your drawdown for that asset specifically. Your drawdown for that asset is going to be associated with your equity and the risk in the market. Okay, so you need to have enough equity to last rises like this. And in a nutshell, that is why people lose money overall. That is what causes people to lose money. Their size of their trade is not in line with the sentiment and probability and all the long-term outcomes of the market, which inevitably and inherently are going to be vicious swings from, like I said, 129 or 130 all the way up to 150. And if you can't handle those swings, you will lose money tomorrow or next year or the year after. Okay. So a couple of questions relevant to what I'm saying. Some of them aren't, unfortunately, but I will answer them anyway. At what point do you pull the trigger? What time frame or price action formation? So, like I said, Mason, great question. I am a swing trader specifically, so I focus mainly on the monthly, weekly, and daily, and the 4-hour. When I want to take entry and get a very specific nitpicking price, if you like, because I am a bit like that, I'll drop to like 5 or 15 minutes. But your timeframes you use are always going to be associated with the style of trading you're taking. So if you're a scalper, you would naturally drop your size incredibly, and you would use very low timeframes. If you're swing trading, the trade is going to take longer, therefore you would have a higher size because there's a bigger spectrum of a price swing. Do I use interest rates to see to basically manage my bias on yen sentiment? Yes, because obviously interest rates are going to dictate whether people buy or sell their yens. Do I think the Bank of Japan will surprise us? Not particularly. There's always going to be talk about that. I would say no, and in any case, you've already got a technical price point that is high in market value anyway, so it doesn't specifically matter. People ask me all the time, and I can see another question in regards to timeframes. What is the best one? There is no best one. It is all about your style of trading. If you're a swing trader, don't sit there on your 1 minute chart and try and work out what way the market is going long term. Put it up to the monthly, and you can see clearly the situation long term. If I put my chart to the 5 minute, it's useless. Okay, I can't see where the market is going in years to come, because all I'm looking at is the market for the last 12 hours or something. So don't worry about that. No time frame is the best. It needs to be relevant for how long you're willing to hold the trade. If you're a swing trader, you'll be willing to hold it for longer. Therefore, you will use a longer, high time frame. The examples are useful, but time frames are improbably large. No, that's not true. Like I said, you can trade on any time frame. Simon Paul, why is every market linked to interest rate? Because interest rates essentially control the flow of money in the economy, like I said. These are things you can easily look up on the internet. It's very basic economics. You know, if people can spend more money and rates come down, stock markets go up, people don't want to save the currency, and vice versa. So that's what that's all about. But again, you can see those rules, which I was saying. If you're going to survive such a harsh move, you need to study the sentiment and study the risk that is applicable to your equity personally, not the guru you saw online with a Lamborghini, but the amount of money you have got yourself. Okay, don't over leverage, in other words. So then that leads me on to my next point about proper risk management, or proper, like I said. Now, this is something which we always go on about and makes our core strategy. We don't use stop losses. I don't use a single stop loss. I haven't for years, and I'll tell you exactly why now. The reason why, like I said, is because I have a specific drawdown per asset and per portfolio. So therefore, if I know what the maximum risk I'm going to incur on such a large market swing is, I can do everything I have to before we get to that point to basically stymie that rate of drawdown, or the increasing drawdown on that asset. And I'll show you exactly how that works now on the pound New Zealand, or any chart, doesn't matter what it is. Okay, Franklin, good point. Don't worry about it. I only answer those because they were relevant directly to what I was saying, but I will answer generally questions like Noah asking about terms of return later on. So proper risk management, stop losses, there's something that everyone looks at online. They think, oh, I need a stop loss, I can't trade without one. That is absolutely and factually incorrect. And you're not being loose and dangerous and risky by not using a stop loss. It's actually completely the opposite. I lost more money using a stop loss years ago than I ever have using without one. Okay, because like I said, if you're setting a 2% stop loss on a trade, what if you're wrong 10 times? You will be 20% down. I won't, because my maximum risk is 2% on an asset spread across a massive portfolio. Okay, so it's much harder for that to occur. And like I said, we use proper risk management, or our proprietary damage control rules. We call it damage control because instead of using stop losses, we start to hedge increments in the market to sustain ourselves. So as the market goes against us, we make small hedges to accumulate gains on the anti side and then take out the accumulating drawdown. Okay, we do that very early before we reach our maximum drawdown per asset, because it gives us a massive amount of room to work that trade out. We call it washing, because what we do is we take gains on the opposing side of the market to wash out the trades that we've got running on the wrong side of the market. You do not have to make a definitive loss. You don't have to trade, you know, exactly with, you know, a stop loss and close it out every single time, because inevitably you will make money. You'll lose money, sorry. So we take a different approach. We don't use stops, and I'll show you a clear example. And we plan our drawdown at all times, and we hedge to accumulate gains, as I said. And the use of a hedging in itself is essentially an artificial stop loss, because when you hedge, you're temporarily taking part of your position away. So it's like a stop loss, but the difference with what we're doing is we don't realize the losses. With a stop loss, you're out and that's it. That's the end. There's nothing more. But if you don't use a stop loss, it's not over, okay? And you can actually hedge as the market goes against you. And that is a skill we teach every day. We're live for 15 hours a week teaching people how to do that on charts. So let me give you an example, like I said I would. Let's have a look. Let's just look at the chat. Blah, 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 blah. Bogdan, in regards to a time frame that's relevant to a day trader, specifically speaking, that is your 15-minute to your daily chart. If you're intraday trading, that is, because if you're looking at your monthly, you're looking months ahead. If you're looking at your 1 or 5 minute, you're looking in the next hour. If you're intraday trading, you're probably going to be looking for about 10-hour span. So those are the ideal timeframes to use. Nyasha, yes, I include, I guess. Mark Harris, great to see you as an Academy member, and he knows the beauty of changing your perspective and being open to everything. So let's talk specifically about what we mean. And there's a few good examples within your pound New Zealand. Now, the easiest way to understand this is the following. If you look at this point down here from October 2016, all the way up to this point over here, okay? Or in fact, I tell you what, we'll take this bit of price all the way to up here. Within this move, what you should notice is that the whole thing is not a straight line. It's jagged, it is an oscillation, it is up and down and up and down. Now, within that move to the upside, it would be a tentative uptrend, okay? People are buying into their pounds and then they're not interested in investing in New Zealand dollars. Again, like I said, ties to the basic economics that determines the value of currencies. But you can also see again throughout that move, it's various areas of price rejection and price action and value. So this area again is where traders who are successful would say, okay, well, this is low enough. It's a good deal. It's just like buying a car for a cheaper price than you thought you'd get it for. And the price rises therefore. Accordingly, the same thing happens to the short side, doesn't it? The same thing happens there to the short side. Now, the difference with what we do is the following. And there's a good example here. So let's say, and these circles I'm going to draw are going to represent where you might have shorted the market. So let's say, well, actually, no, we'll use a red line. Let's say you shorted there, where I'm drawing this line is. Okay, let's say you didn't use a stop loss. And then you shorted again, let's say there. Now, at this point, you've got two shorts wrong. Okay, they've gone wrong and they would start to accumulate drawdown. In other words, the more the market moves away from you, the more you're going to start to accumulate that loss, essentially. Now, there's two ways that can go. If you use a stop loss, you've lost the money. The money, it's over, you've lost it. And the more you make more entries against the sentiment, which you would be battling, the more you're going to lose. And if you're losing 2% per entry, you're going to lose 8% on a tiny move. It's ridiculous. So what we do is we use look at how many weeks this asset sits going sideways. For example, here, this up and down and up and down and up and down move, you could have closed the shorts out at this point, but even if you didn't, you've got literally, well, it goes on for even longer than that, doesn't it? But you've got weeks and weeks and weeks to be buying here and then killing it off the gains. So you could have bought the whole way along for all these weeks. And what would have happened is you would have started to make money. You would have added on more and more gains to your balance. Although the drawdown is rising on the shorts, you're gaining profits on the longs you're taking as a counter trend, okay? Which you can see all the way across. So all of those profits you could have taken there easily would close out these former losses down here, and you would be well in gains anyway, okay? And this happens on all charts, all day, on all time frames, and is applicable to all types of traders, no matter whether you're a swing trader, scalp trader, intraday, doesn't matter. You can always use these things to get rid of those losses. Now, I would say probably the better example in this instance is over here, okay? So let's say you shorted much earlier than I'd said, okay? So you shorted 10180, and then again at 185, let's say, you're a swing trader. At this point, once you get around here, okay, and I'll draw this, let's get rid of the eclipse. Once you get around here, and let's make this arrow a different color, you're going to be in loss on these two shorts. These two red lines are going to be in a losing position. But look at all the red arrows. You could have bought and killed it, bought and killed it, bought and killed it, and bought and killed it repeatedly. And you would have made so much money on the long side hedging that you could eventually just get rid of the shorts. Okay. And we basically do that, and we're able to do it because I could decide on that second short that I wasn't going to add anymore. That's it for me. My drawdown is growing too much. I don't want to take on any more risk, and I'm only going to protect myself to stop the rate of drawdown increasing over time. Okay. And the earlier you do that, the more success you will have in not letting the market rip away with you and cause you all sorts of problems. Now, the same thing is viewable in a much more of an oscillation sense on something like euro dollar, for example. So if you take the price action on euro dollar from where we've got it here, from, in fact, what I'll do is I'll draw blue lines to basically be long. So let's say you took it long there. Where that blue line is, you took it long there, so you've got it wrong, right? You've got that wrong. Let's say you then took it long again here, you've got it wrong again. So by the time you get down here, you've got a decision to make. Do you want to re-long, okay? Or do you want to stop that rate of drawdown? Do you want to stop yourself from getting more and more accumulating loss, okay? Now, the trader that bought here and bought there is already out. They've lost money. It is gone. You've sacrificed the money already. But if you're trading like we do, you could have hedged all of these pops up as the market fell against you. You could have hedged multiple times to the short side. Okay. So if you took 4 shorts there in very simple terms, by the time you get back up to here, okay, where I'm going to draw this eclipse, by the time you get back up to here, you could have just closed out that one and that one, and you would probably be in profit overall, rather than killing the loss straight away. And the same thing is true because you could have hedged all the way down. Look at all the price action levels, like I said before, look at all the market value. That's what candle wicks represent. They represent where orders have gone in and out of the market, and they repeat. And in many cases, the market slows and slows and slows and slows and slows. So that is basically how we manage risk. We cut the stop loss out. We don't use stop losses. Everyone in the academy does not use a stop loss, and there's loads of people in there. Okay, so, and we taught 1,100 people now with a 5-star rating. So it's really, really more about taking, you know, if you lock your mind to say, oh, I can't do anything else, I have to use a stop loss, you're just shutting your world off to all the possibilities. And it doesn't have to be that way. I'm proof of it, and I've said that publicly for years. I don't use a stop loss, and I don't think I ever will. Stan, Eric first, how does it work in futures? Exactly the same way. I mean, it depends what way you're trading the futures and what market specifically you're referring to, because there's a million different futures markets that you could be talking about. Some of them have varying degrees of order structure. Some have varying degrees of stretches in the market. It just depends on the asset. But particularly when I'm mentioning this, you can apply it to things like SPX futures, for example, like on a ticker like this. Okay, any futures market like that, you can do that on, absolutely. Stan, what is your entry signal, if you like, for buying and selling? I would say it's wholly on price rejection and price action. So resistance and support are basically hand in hand, interchangeable terms with price action and rejection levels. They're just telling you where orders have gone in and out in the market, and therefore where the market value is. Because if people are taking their money in and out at a certain point, then there's got to be inherent market value. Eric, do I buy one instrument and sell another? No, not well. I do on a diverse portfolio, but I'll be buying and selling the same asset at the same time. Okay. By hedging, do I mean closing losing trades? No, I mean accumulating long side gains or short side gains and then using that money to close out the former trades. When you hedge, you're not shutting the former trades out, because if you do, you lost money straight away. Okay, that's why I don't use a stop. But when we hedge, we're accumulating profits on the other side of the market, taking the money and then using it to dispel the ones we got wrong, if you see what I mean. And we'll take more questions on that nearer the end. So a couple of things I just wanted to talk through as well, because I'm aware of time. I don't know, it's almost coming up to about 50 minutes, I think we've been doing this. So good amount of time already. I hope everyone's learning. Let me just go back there. So the next thing I wanted to discuss, I'm just going to move myself out of the way, is diversification. And it's basically understanding that if you trade one asset, your risk is all going on that one asset. Okay. And generally, I would say inherently, trading one asset is just going to naturally magnify the risk. If you've ever heard the saying, all your eggs in one basket, it does both ways. It magnifies the risk, and also it stops you making as much money. Because if you're trading more assets, you'll get more opportunities. If you're only trading gold and gold doesn't move, then you won't make any money that day. But if you're trading 7 FX pairs, one of them is bound to move, at least to some degree, and therefore you can make profit in that way. So diversification is really, really important if you're not doing it. Okay. Now that doesn't mean you need to put 60 assets in your portfolio. It can be 3 or 4 or 5. But just more than one specifically is what I'm getting at here. So if you say, look, I'm going to sell my house and go nuts shorting gold, all your risk is on gold, and all the money you'll ever make is on gold, whilst the ORD moves, whilst the FTSE moves, whilst the French CAC moves, whilst everything else moves, you're stone stuck on gold. Okay. So I would very much consider diversifying if that is you, and just spacing things out a bit so you get that wider portfolio. Whenever we teach, we have specific plans for every single asset, specific drawdown for every single asset, and specific drawdown for all portfolios. And we often help people arrange them based on their lives or their approach as a trader, whether they're intraday or day trading or they're swing trading, etc. So in any industry, if you put everything you've got into one thing, your risk just goes up. Okay, so I would very much say if you're going to trade, have maybe 3 assets to start. Don't go crazy and put 10 or 20, put 3 or 4, maybe 5 once you're rolling a bit. And we're able to do this because our sizes are minuscule. The reason why this works is because we take very small sizes over a wide portfolio rather than putting a massive stop loss, massive size on one asset and it going wrong. Okay, like I said at the start and throughout, the longer you do things over a long period with small increments, you naturally lower your risk. You're not looking for the moon and to be a millionaire next year. You're making a steady income. Trust me, it is far better to look to start to make an income first from trading and then take it larger, rather than say, you know what, I want to make millions now and I'm going to do nothing. If you don't believe me, you can go to your dentist tomorrow and let them do work on you after a month. They're going to be rubbish. They're probably going to break your teeth. Okay. Doesn't happen, does it? Doctors, how many years do they train? Okay. Trading is the same. You're not going to get it in a day. It's repetition over time and over a very large amount of trades, not 1 or 2 with a massive size. So that's what we teach. So an example of that, simply, if you look at my watch list, I trade FX portfolio, I trade an indices portfolio separately. So I split the two. And that helps me a lot. Okay, so if you were looking at assets to add, okay, you can see across the board, there's various ones. You've got dollar pairs, your CAD pairs, yens. I don't really trade crypto personally. My strategy is completely applicable to crypto. But if you want to get things a little bit more steady, I would definitely rather trade indices, assets. I trade the FTSE a lot. I trade the French stock market a lot. And like I said, various FX pairs. I'm lighter on the yens because of the inherent risk long term. But I associate all my drawdown and all my risk to all my assets and all my entries, everything like that. So Andreas, if you think you can't hedge in Forex, you might be saying that your broker won't let you do it. Lots of our, for example, American members, they just use 2 brokers, okay? And that's how they get around that, no problem. And I think there are a few other things you can do. And no, I don't mean that if you're long the euro dollar, you'll short something else with a dollar in it. No, you're hedging the exact same asset. Okay, so if you bought the euro dollar and you're starting to accumulate drawdown, you would start to sell the euro dollar to accumulate the short side gains necessary to remove the long side loss. Okay. Absolutely, Stan. We've got funded traders in our academy. Yes, it does work, and it actually works really well because you can massively reduce the risk by doing this, and you'll stay well under the risk limits. Mason, thoughts on crypto? I still think I'll probably do that nearer the end, if that's okay, just because I want to get through the trading rules first. Generally, crypto is a risk-on asset. If you're going to short it, you're running massive risk. It might come down, it might go up. I generally don't want to touch it because I can trade everything else very much safely over longer periods of time. So yeah. And Eric, yes, that's correct. We've got quite a few traders, like I said, here in the US who do exactly that. And there are some other fixes in regards. It does depend on your country, I would say. So the last thing I would say is probably the most important thing. If you don't know this and you don't understand this, you won't get trading right and you'll probably lose money doing it. I talk about it all the time in our academy. It's about natural market flow and the timeframes you use, how they all correlate. Steve, again, I will get to that question at the end, but the answer is yes, it works for that as well. Natural market flow, all your timeframes are relevant entirely to the length of time or the span of the market you're referring to. So we'll do that on charts, and it's because lots of people, when they look at charts, they say, oh, it's uptrending on the 1 minute, but it's downtrending on the 15-minute, or it's uptrending on the daily, but it's downtrending on the monthly, and they don't understand why that is and how every single time frame is respective to itself and the span of the market you're looking at. So I'll get onto that specifically in a minute. We can do that on US pairs. So that means handling positions across the long-term flow of any financial market. And again, like I said, if you're incorporating those risk management methods that I discussed throughout, adding, reducing early, hedging in proportion to the drawdown you've allotted per asset and per portfolio versus your equity, you'll find things a lot easier because you'll start to get the natural flow of the market and trading in and out of those oscillations over time, okay? And that will keep you completely aware of how timeframes work and they correlate together. So practically everyone who loses money doesn't get how timeframes actually work. They understand that timeframes are different ways of looking at the market, but what is the actual use of them? And this is something I love talking about because whenever I say it, people are like, oh, what the hell? I didn't even think about it in that way, I guess. So remember what I said a minute ago. I'm just going to go on the AUD dollar, I think, for this. Where are we? I get lost in all these assets. I'm going to go on the euro dollar and I'm going to move this out of the way for a sec. Okay, so clearly what you can see on your weekly, for example, is the AUD dollar. It's downtrending over this term. Okay, it's downtrending from February 21 to where we are more or less. You have started to have higher lows, which is starting to eradicate that. But generally, if you look at the trajectory long term, you could say it's going down, okay, because it is. Now, what happens if you change to the hourly? What trend have we got now? Okay, well, suddenly you might say, okay, well, it's a near-term uptrend because on the 13th of Feb, you've started to come up. It's fairly flat, but you might say, okay, well, it's uptrending. Now, lots of traders would then get confused, and then they would say, okay, well, if it's downtrending on the weekly and it's uptrending on the 1 hour, which is it? What shall I do? The key is this: the flow of the market. Okay, every time frame is individual. So the 1 hour is showing me what's likely to go on in the near term, what the trend is in the near term. The weekly is telling me what's going on over weeks and months, the long term. Okay, so you've got to understand how this market is flowing, therefore long term. Well, it's downtrending. Okay, so if you're buying on lower timeframes within that, you've got to get while you're doing it, and you've got to stop doing it early enough. Okay, so I'll tell you what I mean. If you look at this weekly chart, you peaked up here and the price is high, therefore. If you then go to your 1 hour and you say to yourself, you know what, I want to buy the dip, you're going to be buying a very high price. Okay, all right. Now, I know we're on the hourly at the moment, but if you look at the weekly, you're primed to continue that downtrend as you did all these other times. Whether you think the oil dollar is going to go down or not, it doesn't actually matter. If you just look at the past, it has considerably. And again, this is another instance where you could have hedged the market down if you longed it. If you bought it there, you could have hedged the short side all around here, and you would be out for gains. And you could have hedged, and you could have hedged. Thanks, by the way, Franklin. You're a big fan. That's great to hear. And you're saving up. Brilliant. Good for you. And thanks for coming along to all my things. So there you go. You know, you could have hedged it. But what I'm saying is the market is moving down long term. So if you're going on the 1 hour or the 15-minute and saying, oh, wow, this is a brilliant uptrend, I'm going to buy it, you're buying at a high long-term weekly level. Okay. So you're buying at the highest point in a long-term down move. So if that down move continues, as it has for years, you're going to get cleaned. You're going to get cleared out because you're not looking at how the timeframes are individual. Okay. So yes, this is an uptrend on the 15-minute, but it's not on the long term. The long-term market's coming down. So you're only going to have a limited amount of time to trade it to the upside. So your exits, therefore, going to have to be much sooner. Your risk management is going to have to change. Your drawdown per asset might vary per portfolio, and so on and so forth. Okay. So those things have to all be known. They've all got to come together in some way so that they make one system of concise risk management and consistent gains. And that's basically how I trade in a very diverse portfolio. Okay. So it's very important to note that. Andreas asked, what's my portfolio return? Many traders won't tell you what theirs is. They don't want to know. As a swing trader, mostly for myself per year, I like to make more or less up to 150%, not working an awful lot. I don't sit here and sweat all day scalping the market. Some of our traders make 300% a year. It just depends how much you work. If you're sat there more and more and more, you can make hundreds of percent. That's completely up to you. But I like living a relaxed life and also getting paid at the same time. So that's why I take those entries. Lots of our guys sit there and they're quite happy. Some of them make 1% a day. Some of them make 10% a month. It's still 120%. Some make 20% a month. And it's just down to you. The more you trade, the more money you make. It's as simple as that. That is literally logical fact. It's not about being, in some way, it is about being a good trader, don't get me wrong, but it's also about spending the time to get the opportunities to take good entries. And if you're making money every single year, and quite a lot of it, you know, that's no problem. Even if for you that was 40%. I mean, if you look at a hedge fund, you know, if the market's not going wrong, they'll make like 10, 15%. They'll be overjoyed. They'll be popping champagne. If you invest in the stock market in a good year, you might make 7 or 8%. Okay, depending on what you buy. If it was generally boring blue chip companies, it would look something like that. So making 20 times that and not doing loads and loads of sweat work here all day is much better. Okay, I could sit here and say, look, you'll be a millionaire and you'll make 1,000% next week trading crypto. It's bollocks. It's not true. It's not going to happen. Nobody is going to do that for you. Whether you believe it or not, that's up to you. I just like teaching things that work consistently and are proven to work. Okay, and I think that's why I get a lot of engagement in all my things, my streams and posts, etc. And that's what we're all about, just helping people to learn so they can change their lives. So I know it's hard, you know, if you're sat there and you might have been trading before and stop losses are getting hit, you're getting margin calls, you're stressed, you're up at night, it sucks. Prices going against you every time because you don't understand value and probabilities and the probability of all markets. You don't understand natural flow, how to incorporate all time frames so that you can be accurate long term. You're then going around in circles doing the same thing, and you start to eventually get to that point, that very horrible point where you start to lose money. I lost money at the start. My mentors lost money at the start. Their mentors lost money at the start. Everyone who learns without proper risk management and proper mentors will lose money. okay? Then when you find what works, as some of you guys who are in my academy in this chat are already, and some of you who come to every stream like Franklin does, you know, you'll start to see there's a bit more to it than just being a moon boy and buying things at all-time highs and gambling, basically. If you want to go gambling, the casino might be open probably 24/7 because they're always there. Take your money. Trading brokers are not casinos, okay? And you're only going to experience this if you don't get the natural flow of markets, the repetition that therefore needs to be included for you to reach a level of success. And the risk management part, allotted drawdown per asset. And most importantly, I would say putting your foot down early enough to slow the rate of drawdown, we call it, and prevent any growing loss that is unsustainable for you. Every trader who loses money doesn't get the long term. They don't get the long-term picture. So they take ridiculous risks and they get absolutely cremated like they will be in the risk on market now. And like I said, there's poisonous mentors everywhere. Like, you know, I said, I like sitting, I like teaching people, I like making money trading myself. You know, I'm not looking to buy a Lamborghini tomorrow. I never was. I enjoy my life. I trade well. I make money trading, and that's what it is for me. That's reality. That's reality for everyone who trades and makes money. Okay, everyone who doesn't will sell you the dream, and that's why there's a bin there. They will sell you the dream of it making you rich immediately. You can be rich doing it. Absolutely, you can make millions of dollars doing that. But it's just what suits you and how fast you want to progress at it. But it's always about who teaches you. You either get real people who teach you or you get fake people who sell you, okay? So that's why I spent so much time on charts, because, you know, I didn't want to sit here and make it all boring about, I've seen some other webinars and they're quite slow. Anytime you see the wealth involved, it's probably going to be something that's somewhat fake. So I never put anything like that out. So in short, what works, I guess, to summarize what I've said, and please do ask questions if you've still got them. Trading like people have since the beginning of time, since you had market stalls in the street, buying low and selling high is literally what works. Doing that within a manner that is controllable for your equity and your personality and the market scenario at the time is absolutely essential. You need to lessen your risk when there is inherent risk in the market. You should never be upping your risk to something that's sustainable. And you should understand the natural long-term flow of all markets, where the best deal is, okay? So making deals in and out of the market, where is it probable that my entry is going to turn the way I want it, okay? Am I buying at an area where someone who's professional or an institutional trader would also be saying, wow, that's a great deal, you know? There's a lot of things I like, and whenever I try and buy something, I want a good deal. I think everyone in here probably says, well, can you do this price? Or could it be like this? Or you'll search around a bit. Everyone wants to pay less. That's an inherent fact of being a human. That's the nature of being a human. You wouldn't be a human if you didn't do that. So it's all about making deals at good points, and institutional investors and professionals like myself know where those points are because we've sat here and studied them. We know the exact rules. Managing risk for all assets, it's got to be tied to your equity, like I said, and the market sentiment at the time, the risk market at the time. Okay, at the moment, for example, like again, you can see on Financial Juice, there's tons of risk events, or there's tons of risk on sentiment coming in. People are flooding their money into risk on assets. That's why Bitcoin's flying up. That's why stock market's going up. If you don't know that's going on, you're going to struggle because you don't understand even from the basic principle of what's going on. You can't ignore that. You need to be able to see that. And that comes right into understanding the natural flow, because it's all well and good understanding why something is moving from a fundamental basis, i.e. the sentiment, the mood around the market, economic data, the reflections of the central bank, because essentially the central banks are what control everything. So all you really need to care about is what they're going to do. That comes all hand in hand with the natural flow of the market, because from a technical perspective, what that will look like over time is an oscillation. It will look like people buying at a great deal here and selling at a great deal here, and buying and selling, buying and selling. So if you're not trading within oscillations, you're trading against the natural flow, and therefore you might find things get slightly harder than they need to be, or in many ways your risk is going to be completely out of line with the natural flow of any market, and you'll struggle because what you'll do is you'll start buying high and selling low without even realizing it, like I just showed you a minute ago on that chart we had for the oil dollar, for example. Okay. So if you want some reality, therefore, someone asked me about results. We're 5-star rated, or my academy is. We taught people in every continent, all over the world. I stream most days as well and teach some basics to people, but we go live for 2 or 3 hours a day in the live room. So if you want to learn to trade for income, you need a plan. You need something that is going to be referred to every single time you wake up and go into the markets. And you'll need to study that every day. You'll need to know, what sentiment you've got, what's going on, and your entries, exits, your drawdown per asset, everything like that. You'll need to be consistent with that plan. So when you do refer to it, you'll refer to it again and again and again and again. And myself and my co-founder, Alex Sorrow, would teach people all day. We will teach you in the live room. Then if you're stuck, we'll sit with you for the rest of the day, if need be. That's what we do. It's in our blood, and we love doing it, I guess. So you'll need a plan. You'll need to be consistent with it. Now, a plan is not something you just chuck together willy-nilly and you say, you know what, I'm going to buy at this price action level and I'm going to sell at this price action level. Oh, I'm only going to have 4%, not 3% risk. It's never going to work like that. Okay, you can't just chuck it in. You need something that people are doing, which is making money, which you can then reflect on. You can learn again with us for 3 hours a day. Live on charts with us personally there. You type a question, we'll answer it, we'll speak it to you basically and write it on the charts. Someone who will sit down with you and help you. Lots of people who run academies won't do that. They won't do that at all. So like I said, here's one of our reviews, and it sums it up. It was one I picked specifically. There's a link there in the chat box. I wouldn't use that one because it's going to take you to our homepage. What I'm going to do is I'm going to put a different one up in a minute, and it will take you to exactly what to refer to. But like I said, we do 10 to 15 hours every week, week in, week out, no problem. Lots of our members get at least 1.5k pips a week. For myself, I normally average 5,000 or 6,000 a month. The trading room is the perfect place if you want to know how to trade. Their teaching is more than what you can expect from a trading room. You learn everything you need to know about Forex or trading in general. If your goal is to be a real trader, this is the place to be. So lots of our reviews are very much like that. We're a very honest academy and honest trading room because we're there every day. You can consult us right there. We don't just hide and run away. You'll get hundreds of hours of videos and everything you need. So there's a newer trader experience. In the bottom right was us live in the Zoom room earlier with our members. That's a euro pound you can see today if you want to go and check the chart or whether it's the right one. But yeah, we were live again for a couple of hours yesterday, running over all charts, all strategy, answering all questions, every single part of our strategy overall. And again, a review, someone who's newer, I thought that would be handy as well. They say just try it and you'll see what happens. Most people who come in and try it are very, very much completely into it. You gain the confidence needed. And lots of people come in and say, wow, I've never seen markets like this. I've never found people who help me as much. And this is fantastic. So another great review there. And we also call all our trades out all day on all assets. Everything we're taking, our entries, exits, we call it out live to you. I can vouch, there's one in the chat box. Thanks so much, Wayne. I really appreciate that. I can vouch for Alex and Will, genuine guys. I'm a former student as well, Daniel B. Thanks so much. I made the best results of my life. That means so much to us. Thank you. Thanks, Daniel. I really appreciate that. Wayne as well. Great to hear. I see Wayne's in now. Daniel B, I hope to see you again. I know you've obviously done things really well anyway. But that's fantastic. Yeah, my co-founder, co-mentor, Alex, is the one who runs a trading room with me. He's a veteran trader, 10 plus years experience, taught absolutely loads of people. And again, you can see the results in the chat. So with this, hundreds of hours of recorded training, might even be 1,000 hours or more of recorded training. We'll teach you every day on charts, everything you need to know, any question you want. There has never been a time where I've said, I don't know the answer. We can help you. We can help you structure your portfolio, everything. Mark Harris, another person in the academy, thank you so much. Will, I consider best in the market. I do appreciate that. Thanks, Mark. That means a lot to me. Thank you so much. Thanks, guys, for your comments there. I didn't know that was going to happen, so that means a lot. Thank you so much. You get all indicator packages, all risk management plans. We'll help you whenever you need it, all day, all night. We don't care. Whenever it is, it's fine. We will help you out. You get guided trading plans. We call all our trades out, but most importantly for people, we do 2 or 3 hours live with us. You can consult us. You can say things to us. We will physically be there and answer you every single day live on charts. Live on charts, we'll draw it all. You can see what we're trading, how, why, and when. We take trades all day. So for this webinar only, I'm going to do a discount offer. Like I said, you'll get 2 or 3 hours live with us every day on charts, hundreds of hours of recorded videos for our training. So I'm going to put the link in here. That is the one you will need if you want to get on board. It is right there on the screen now. If you want to type it in the browser or you want to click the link there, once you press that, you will be taken over to this page, and you can either get a monthly subscription here, or you can get the free monthly subscription here, or the yearly subscription there. Quite a lot of guys take the free monthly and yearly because there's a really good saving there. But the value works out incredibly. I mean, because we're giving you 15 hours live a week, it is absolutely minuscule, the cost, minuscule for what you get and the time we will spend with you and help you get up to speed, okay?